In this video, I want to take a look at what I feel are the 10 best growth funds out there that you might want to consider for your portfolio. Now, most people have something like the SP 500 or the total market fund as kind of the core of a portfolio. But then oftentimes they like to pair that with a growth fund to help with better performance. And the funds that we'll be considering here all have a very long track record, 11 to 26 years they've been around. All have very good annualized rates of return, very low expense ratios, so your expenses are at a minimum. And we'll take a look at the volatility that you should expect with each one, the overlap that they have with the SP 500, the tech exposure, top holdings, and more. And I'm also going to throw in 3 surprise ETFs that I think you might want to consider in this category. Okay, so let's jump right in. I do want to say I hope you hit the like button though. Leave me some comments below about what you think of this list and if I missed any of your favorites. Okay, the first one's probably the most popular one, and it's the one that's been around the longest. QQQ, Invesco's ETF that tracks the NASDAQ 100. It's been around since March of '99. Since then, its compounded annual growth rate is 10.42%. Now, that may not sound great, but notice it came right before a really bad decade. In 2000, 2001, 2002, the market was down 3 years in a row. And then, of course, we all remember what happened around 2008. The stock market crashed, the global financial crisis. So that was a really bad decade. Now, for comparison, the SP 500 did 8.52% over that same period of time. Now, however, its 10-year average is 19.45%. The SP 500 is 15.55. Its 5-year average is 15.06. SP 500 is 14.97. In 2022, it's always a good idea to take a look at what happens in a bad year. That year, the SP 500 was down about 18%. This one dropped 32.51%. It currently holds 100 companies, the NASDAQ 100. Its expense ratio is quite low, 0.15%. That means on a $10,000 investment, your fees would be $15 a year. It has 63% devoted to technology. The top 10 holdings make up 48% of this fund. It has a 51% overlap with the SP 500, and its beta score is 1.12. What this means is a beta score of 1 just means that it will move the same essentially as the SP 500, which represent the market overall. Okay, so if the SP 500 goes up 10%, you could expect a beta of 1, that fund to go up 10%. What this means, it's about 12% more volatile. Okay, the swings would be about 12% more than the market overall. Now, the reason we want to look at a bad year, notice if something drops 32.5%, it's got to go up 48% to get back to even. Okay, so drops do matter. Now, the top 10 holdings of most of these growth funds are going to look very, very similar. NVIDIA, Apple, Microsoft, Amazon, Meta, that's Facebook, Google, and so forth. Okay? Now, I do want to look at that period I was just referring to, from 2000 to 2010. What we're looking at here is if somebody would have invested $10,000 into QQQ and also the SP 500 annualized return, okay, over that period of time. QQQ actually had a negative annualized rate of return of 4.43% over that period. If you would have invested $10,000 at the beginning of 2000, at the end of 2010, you would have had $6,073 left. Okay, so a very difficult period. The SP 500 was barely positive. It only averaged a 0.36% rate of return. And so if you would have invested $10,000 into the SP 500, you would have finished 2010 with $10,403. We want to keep this in mind because these growth funds are going to look great when we look at them. They're going to all beat the SP 500 over the last 5, 10, 15 years. But if we do have some weak periods, for example, we'll look at 2022, okay, or if we have several years, okay, kind of a weak economy, you can expect these typically are going to have larger drawdowns and they're going to do worse in weak markets. Okay, so just something to be aware of. Okay, in strong markets, these are going to do great and outperform. In weak markets, they're going to be a little bit more painful. Okay, now, next one we'll take a look at is SCHG, Schwab's U.S. Large Cap Growth ETF. It's been around since December of 2009, so it missed all of those bad years. So since its inception, it's averaged 16.65%, the S&P 500 over that period of time, 14.99. 10-year average of this one is 18.47. 5-year average is 15.75. It dropped approximately 32% in 2022. It currently holds 196 companies. Very low expense ratio, 0.04. On a $10,000 investment, your fees would be $4 a year. 45% in technology, 59% just in the top 10 holdings, 54% in overlap with the S&P 500, and the swings would be about 15% more than the overall market. Top 10 holdings, going to look very, very similar to QQQ. The next one, VGT, Vanguard's Information Technology ETF. It has technology in the name. This one's been around since January of 2004. Since then, it's averaged 13.96%. Over that period of time, the S&P 500 did 10.71. Its 10-year average is 23.2%. 5-year average, 17.11. 2022, it dropped about 30% again. It holds 320 companies. Very low expense ratio. 98%, essentially all of it is technology. It's in the name. Top 10 holdings, 59%. 54% overlap with the S&P 500. And its swings would be about 27% greater than the overall market when we do experience volatility. Again, the top 10 holdings going to look very similar for all these, except this one here, just the top 3 companies make up 44.57% of this fund. Okay, so this one's a little bit more top heavy than the rest. Okay, SPYG, the State Street S&P 500 Growth ETF. Now, this one had the unfortunate luck of starting out that really bad decade again. It started in 2000. So since then, it's averaged 7.17%. The S&P 500 did 8.81. So not great there, but look at the last 10 years, 17.57% rate of return. 5-year average, 15.22. Dropped about 29.42% in 2022. It holds 138 companies. Very low expense ratio. $10,000 investment, only $4 a year. 47% in technology, 61% in the top 10 holdings, 65% overlap with the S&P 500, but less volatile. It's only the swings when we have volatility would only be about 10% more than the overall market. Top 10 holdings, again, very, very similar. Okay, VUG, Vanguard's Growth Index Fund ETF. It's been around since January of 2004. Since then, it's done 11.94% rate of return. The S&P 500, for comparison, 10.71. 10-year rate of return, 18.03%. 5-year, 14.57%. It dropped 33% in 2022. It holds 151 companies. Very low expense ratio again. 65% devoted to technology. 64% in just the top 10 holdings, 57% overlap with the S&P 500, and the swings, we would expect them to be about 18% more than the overall market. Top 10 holdings, again, look very, very similar to the other growth funds. Now, MGK, Vanguard's Mega Cap Growth ETF. This one's a little different. It's been around since December of 2007. Since then, it's done 13.57% rate of return. Over that period of time, the S&P 500 did about 11. Its 10-year average is 18.83%. The 5-year average is 15.59%. It did drop 33.56% in 2022. It only holds 60 companies, just the mega cap growth. Again, very low expense ratio, 68% devoted to technology, 66% just in the top 10 holdings, 51% overlap with the SP 500. And we would expect the volatility when we experience that this would have swings about 17% more than the overall market. Again, very similar companies here in the top 10 holdings. Okay, IWY, iShares Russell Top 200 Growth ETF. This one's been around since September of 2009. Since then, it's averaged 17.29%. Over that period of time, the SP 500 did 14.99. Its 10-year average is 18.96%. 5-year average, 16.49%. It dropped 29.91% in 2022. It holds 110 companies. Its expense ratio is 0.20. So again, $10,000 investment costs you about $20 a year in fees. 52% technology, 63% just in the top 10 companies. 57% overlap with the SP 500. And its market swings, we would expect that to be about 12% more than the overall market. Now, again, very, very similar top 10 holdings. Now things are going to get a little bit different, these last three. Okay, XXMO, Invesco S&P Midcap Momentum ETF. Now, this by definition is not really a growth fund. However, it kind of performs similar to one. What this is, we're going to take a look at two momentum funds. They actually readjust these holdings twice a year, and they pick the stocks that seem to have the best momentum using, their formula. Now, this is one that I kind of like. It's been around since March of 2005. Since then, it's done 11.9% rate of return, which does beat the SP 500 at 10.7 over that period of time. Its 10-year average is 18.65%. The 5-year average is 12.47%. In 2022, when those other growth funds dropped around 30% and the SP 500 dropped about 18%, this one actually only dropped 16%. It only holds 77 companies. Expense ratio is a little bit higher. $10,000 investment would cost you about $35 a year. It's only 19% technology though. Okay, so if somebody's actually looking for some diversification in a portfolio, notice all of those other growth funds we looked at, they had around 50% overlap, most of them, with the SP 500. This one has zero overlap with the SP 500. So if you added something like this, you are truly adding diversification. The top 10 holdings only make up 24% of this fund. We would expect swings to be about 24% more than the overall market though. Now, if we look at the top 10 holdings of this one, they do look completely different, because notice this fund doesn't have any overlap with the SP 500. Okay. These are mid-cap companies. Okay, so again, something like this, just something to consider because it does add diversification with the opportunity for a little outperformance. And the same with this one. I actually really kind of like this one. SPMO, Invesco's SP 500 Momentum ETF. Again, by definition, not really a growth ETF, but it kind of behaves like one. It's been around since October of 2015. Since then, it's done 17.79% rate of return. SP 500 did 14.86 over that period of time. Its 10-year average is 18.5%. 5-year average is 19.08%. In 2022, it actually dropped less than all of the other funds, including the SP 500. It only holds 100 companies. Its expense ratio is pretty low. Okay, it would only cost you $13 a year on a $10,000 investment. Only 33% technology. It does have 51% just in the top 10 holdings. Only a 30% overlap with the SP 500. And we would expect the market swings in this one to be about 15% more than the overall market. Okay. Here, you're going to see similar on top. We do have NVIDIA, Broadcom, here's Facebook, but then notice we also get a bank here, Palantir, Walmart, Netflix, Visa. Okay, so the top 10 here, okay, it looks a little bit different than the other growth funds. This is not really a growth fund, but has very good performance. And then the last one. This is also not a growth fund. And it's not a momentum fund. It's just a very narrowly focused fund that has really great performance because of what's happening in our economy. We have a shortage of chips. The chip demand has been crazy the last decade. So this is SMH, okay, a semiconductor ETF. It's been around since February of 2011. Since then, it's averaged 26.89%. The SP 500 did 14.08. Its 10-year average is 30.93. 5-year average, 27.73. It did drop 33.52% in 2022. It only holds 26 companies currently. This is very narrowly focused, not diversified in any way. Okay. Its expense ratio, 0.35%, 100% technology, semiconductors. The top 10 companies hold 75% of the funds. It does only have a 15% overlap with the SP 500. And you can see here, we can expect any market swings. This fund, we would expect it to be about 61% more volatility than the overall market. Now, the top 10 holdings, NVIDIA, Taiwan Semiconductor, Broadcom, Micron, okay, all chip companies. This is a company that's had great performance, but it does come with more risk because it's narrowly focused. If we did have something happen to the economy, okay, if chip demand slowed down for some reason or whatever, this one would get hit potentially much worse than the others, but it's had amazing performance, okay? Now, a few things to keep in mind. Certainly, growth funds can boost a portfolio's return during strong markets, and we've been in a strong market since about 2010. Okay. Growth funds are more volatile. You should expect that. And they often will underperform in weak markets, which that's why we looked at from 2000 to 2010. Okay, if we go through, if the economy gets weak for some reason, these will typically get hit far greater than the overall market. You need to build a portfolio that fits your risk tolerance so you can sleep at night still when we experience volatility. Okay. Higher potential returns comes with higher risk. That's how investing works. Okay. And all of these funds are good. We looked at the rates of returns and they're great. Okay. They all beat the SP 500. But again, if we have a weak period, they most likely will underperform the overall market. So of these 10 that I covered, and 3 of them really weren't actually growth funds, what are your top 3? And did I miss any of your favorites that you like? So leave me some comments below, hit the like button, and I'll see you next time.